Welcome back to the Deep Dive. Today, we are stepping right into the friction of January 2026.
We are.
And I have to say, the financial mood music right now it's strange. It's really discordant.
Discordant is the perfect word for it. It really feels like we're living in two different realities at the same time.
Right, because on one hand, you look at the macro picture, the big institutional money.
The pension funds, insurers.
Right, all of them. They are absolutely bracing for impact. They're looking at the geopolitical map and just seeing red lights flashing everywhere. But then you walk into the room where the U.S. crypto regulations are being written, and it's like a totally different party.
Completely different. The lights are on, music's playing.
And the regulators, who used to be the bouncers, kicking everyone out, are suddenly handing out VIP wristbands.
It's a fascinating juxtaposition. You've got this high-level, almost paralyzing anxiety about the physical state of the world.
Right.
And it's contrasting so sharply with this ground-level boom in regulatory clarity for the digital world. I mean, we haven't seen a shift this aggressive in the U.S. in decades.
So that is our mission for this deep dive. We're going to unpack how these regulatory floodgates have just suddenly flung open in the U.S. right as the market hits what the data is calling a psychological pivot point.
And we've got a great stack of sources today.
We do. We're looking at the Natixis institutional outlook, some regulatory updates from Cleary Gottlieb, and then, some nitty-gritty market data from TradingView and crypto.
We really need to make sense of this friction, because if you're an investor, or even if you're just paying attention to the economy in 2026, understanding this clash between fear and opportunity is, well, it's going to be the difference between sinking and swimming.
Okay, let's unpack this. Let's start with the fear part. We're looking at the Natixis 2026 institutional outlook. This is a survey of the heavy hitters.
Right, the institutions who manage billions.
And the vibe check is, well, it's pretty grim.
It is grim. The headline they actually used for the report was Dancing in the Dark.
Which is never a comforting title for an economic outlook. It suggests nobody knows where the furniture is.
Exactly. And the numbers are stark. 74%. 3 out of 4 of these institutions believe the markets are due for a correction.
3 out of 4. Wow.
But what's really fascinating is what they're afraid of. For years, the boogeyman was always a tech bubble or, a recession.
Right, the usual suspects, interest rates, inflation, all that.
But not this year. Now, the top threat is geopolitics. 49% of respondents ranked geopolitical conflict as their #1 fear.
And that's higher than a tech bubble, higher than a recession.
Higher than everything. Higher than a debt crisis, even.
And we aren't just talking about, standard trade disputes here, are we? I was reading the breakdown of these fears, and it gets, frankly, a little sci-fi.
It does. 63% of these very serious financial institutions are specifically worried about conflict in new frontiers.
You mean space in the Arctic?
Space in the Arctic, yeah.
Space wars. The people managing our retirement funds are worrying about conflict in space. That is a sentence I really didn't think I'd be saying in 2026.
It sounds wild, but it just shows you how much the risk landscape has shifted if satellites go down.
The economy goes down.
The economy goes down. And 66% are worried about a trade war impacting the global economy. So you have this backdrop of the world is dangerous, trade is fragile, and conflict might happen in orbit.
So logically, if they're this scared, they must be fleeing to cash, right? Yeah. Stuffing money under the mattress.
And that's the contradiction. They aren't. Despite all the gloom, 68% are still bullish on stocks.
So they're not fleeing.
They're diversifying. They're moving heavily into private assets, things like private equity, infrastructure, because they see the public markets as just too crowded.
And this brings us to the biggest surprise in the data, the crypto pivot.
This is the statistic that really jumped out at me. 36%. 36% of these institutions plan to increase their investments in cryptocurrency this year.
Which is massive, considering where we were just a few years ago.
It's a complete 180. The report notes that just a couple of years back, 65% of these same institutions said crypto wasn't even a legitimate investment.
Then now?
Now, almost half say it is. That is a complete reputation overhaul in a very, very short window.
This seems so counterintuitive, though. If you're worried about satellites getting shot down and trade wars closing borders, why would you put money into magic internet money? Isn't crypto supposed to be the risky asset?
Well, that's the pivotal realization, I think. In a world where physical trade routes and traditional treaties are crumbling, a digital, decentralized financial rail It doesn't look like a casino anymore.
It looks like a lifeboat.
It looks like a lifeboat because it's not tied to a specific port or a specific shipping lane.
It just exists outside of all that.
Exactly. It operates independent of the physical supply chains that everyone is so terrified about. But, and this is a big but, a lifeboat only works if it doesn't have holes in it.
Right.
And for a long time, the hole in the crypto lifeboat was the U.S. government, the fear that they would just ban it all.
Which brings us to the legal environment. You're saying that hole has now been patched.
Completely patched. I mean, we have to look at this report from Cleary Gottlieb about the U.S. regulatory shift. They called 2025 a landmark year.
Yeah, but lawyers call everything a landmark. Was it actually substantial?
Oh, it was transformative. The landscape in the U.S. changed virtually overnight. We went from what they call enforcement-heavy crypto skepticism.
Basically suing everyone who touched a token?
Yeah, basically that, to a determined focus on flexibility.
Can we get specific on that? Because flexibility can sound like a buzzword for, oh, we'll think about it later.
No, this is concrete action. In 2025, the SEC dropped nearly all enforcement actions against fintech companies, where the only allegation was a lack of registration.
So if there was no fraud,
If there was no fraud, they dropped the case.
that is a sea change. So if you were just trying to build a business but hadn't filled out the right form, they stopped hunting you.
Precisely. And it gets even more specific. The SEC established a crypto task force that issued new guidance clarifying that payment stablecoins are not securities.
Okay.
They even clarified that meme coins purchased for entertainment or cultural purposes typically aren't securities either.
Wait, seriously, so buying a coin with a dog wearing a hat is officially culture now in the eyes of the U.S. government?
Essentially, yes. As long as you aren't expecting a profit based on the managerial efforts of others, it's viewed more like a digital collectible. But the real heavy hitter here isn't the meme coins, it's the legislation, the Genius Act.
I love the names Congress comes up with. The Genius Act. What does it actually do for the average person?
It's a game changer for payments. The Genius Act sets a federal framework for payment stablecoins, and crucially, it places them under the supervision of the OCC.
The Office of the Comptroller of the Currency.
And state banking regulators.
Okay, stop there. Why does it matter that it's the OCC and not the SEC? That sounds like alphabet soup to me.
It matters because the OCC regulates banks. The SEC regulates stocks. By moving stablecoins to the OCC, the government is saying, these aren't risky stocks you gamble on. These are banking products, like checking accounts.
So this clears the way for my actual bank, like the brick-and-mortar bank down the street, to hold stablecoins.
Exactly. It gives banks the green light to engage with them. It creates a blueprint for stablecoins to be used in everyday transactions, like buying coffee or settling a mortgage.
And we can't forget the executive branch's role here. The source mentioned a presidential working group.
Yes, convened by President Trump.
Yeah.
Their stated goal is explicitly to make the United States the crypto capital of the world.
So you have Congress, the SEC, and the White House all pointing in the same direction.
All pushing for adoption. That is why institutions are buying. The regulatory risk has, largely evaporated.
Okay, so the suits are happy because the laws are clear. But let's look at the actual market, because the price action tells a more stressful story. We're looking at data from TradingView and Being Crypto here. Bitcoin is trading around, what, 89, 90,000?
Right around there, yeah. And we have to remember the record high was $126,200 back in October 2025.
So we are significantly down from the peak.
We are.
And this is where it gets really interesting or nauseating for anyone holding a Bitcoin ETF. There's this concept of the psychological pivot point.
This is a critical metric. It's called the ETF realized price.
Okay.
Basically, if you take all the people who bought Bitcoin ETFs and average out their purchase price, you get $86,600.
And we are hovering at 89,000. That's uncomfortably close.
It is the danger zone. The analysis from CryptoQuant suggests that historically, this price level acts as a pivot. If the price stays above 86.6, investors feel smart.
They feel conviction, they hold.
But if it drops below,
then the psychology flips.
Completely. You aren't locking in gains anymore. You are tolerating drawdowns. You're losing money.
Right.
And that is when panic selling usually starts.
And we are already seeing some jitters, right? ETF holdings have tumbled by, what, $6 billion recently?
Only about that, yeah.
Okay, but let's be real. Break-even battleground is a nice way of saying a lot of people are sweating. If I bought a Bitcoin ETF at 100K and it's trading flat while space wars are looming, I'm not feeling conviction.
No, you're feeling sick.
So why aren't we seeing a total capitulation?
Because of who is holding the bag now. It's not just skittish day traders anymore, it's the wirehouses.
You mean firms with 10,000 advisors managing family wealth?
Exactly. And they move slowly. The sheer bureaucracy of these big firms is kind of acting as a price floor.
That's fascinating.
Yeah. Bitwise execs report that major U.S. wirehouses are still greenlighting these ETFs as of this month, January 2026. It takes a long time to steer a tanker.
And right now, the tanker's still steering in, not out.
Right. And QCP Capital notes that while there's heavy downside hedging, people are buying insurance against a crash, the volatility itself is actually contained.
So it's a stress test, not a crash.
Correct. It's a battle between the nervous investors who bought the top and the new institutional money that's just now entering thanks to all that regulatory clarity.
All right, let's zoom out from Bitcoin. Because while Bitcoin is fighting this psychological battle, the technology underneath the rest of the market isn't waiting around.
Not at all.
We have roadmaps here for Ethereum, Solana, and XRP. And I want to get technical for a second because the jargon here it's pretty thick.
It is, but the changes are profound.
Let's start with Ethereum. They have this upgrade coming in 2026 called Glamsterdam.
Great name.
Sounds like a 70s rock band. But the documentation says it focuses on enshrined proposer-builder separation.
Yes, EPBS.
Okay, that is a mouthful. Translate that for me.
Yeah.
Why should a regular person care about proposers and builders?
Think of it like a high-end restaurant. Right now, in many blockchain systems, the chef, the one cooking the transaction block, is also the waiter who's serving it to the network.
Okay, I'm with you.
The problem is that chef/waiter can prioritize their own friends or, rearrange the orders to make a quick buck on the side. It's inefficient and prone to bias.
I see.
Glamsterdam splits those roles. One specialized group builds the blocks, those are the chefs, and a totally different group validates them, the waiters.
So you can't bribe the waiter to cook your food faster anymore.
Exactly. It removes censorship risks and makes the global computer much, much harder to manipulate. It ensures neutrality.
So it's plumbing.
It's plumbing, yes, but it's the kind of plumbing that prevents the pipes from bursting when the whole world tries to use them.
Okay, that makes sense. Now let's talk about the speed demon, Solana.
Solana is swinging for the fences in 2026. The big story there is the Fire Dancer upgrade.
Fire Dancer. Sounds aggressive.
It is. It's a new validator client, basically the software that runs the network, that aims to push the network to over 1 million transactions per second.
1 million. Just for context, what does Visa handle?
Visa usually handles around 65,000 per second, so we're talking about an order of magnitude faster.
Why do we need that much speed? Are we buying that much coffee?
It's not for coffee. It's for high-frequency trading. They're calling it Internet Capital Markets. The goal is to put the stock market, the bond market,
Everything.
everything on chain. And Western Union is already debuting a stablecoin on Solana. The Solana co-founder is predicting their stablecoin ecosystem alone will hit $1 trillion by the end of 2026.
That is ambitious. But speaking of ambition and long battles, we have to talk about XRP. For years, the story with XRP was just the lawsuit.
And that story is finally over. The SEC versus Ripple case officially ended in August 2025.
And the verdict was?
It was mixed, but a victory for the asset itself. XRP is not a security in retail transactions.
But Ripple had to pay a penalty.
They did for their institutional sales, $125 million. But the cloud is lifted.
And the market reaction?
Immediate. XRP ETFs raised $1.3 billion in just 50 days.
Wow.
But the real news is the utility. Ripple launched the RLUSD stablecoin, which is integrated with Visa.
Integrated with Visa. That
Yeah.
seems like a huge step for a coin that was in court for half a decade.
It is huge. Analysts are now projecting price targets of $5 to $10 in 2026 because they see it acting as a bridge currency for global finance now that the legal handcuffs are off.
So it's finally allowed to do the job it was designed to do.
Exactly.
So we have the U.S. becoming the crypto capital, Bitcoin fighting this support level, and the tech scaling up to replace the stock market. But is this just a U.S. story? What's happening across the pond?
That's the bigger picture segment. We've got a report here from PYM NTS on the European Union, and 2026 is their deadline year.
Deadline for what?
The digital euro.
So Europe is doubling down on the CBDC, the central bank digital currency. But looking at the report, it seems like the dream of a citizen's digital wallet is hitting some political snags.
It is. The retail side, the app you or I would use, is bogged down in privacy debates. People are worried about government surveillance.
Sure.
But the wholesale side, they're calling it Project Pontus, is moving at warp speed.
Explain wholesale in this context.
This is designed for banks. It's for them to settle tokenized assets using central bank money.
And it's going live soon.
Scheduled to go live in late 2026.
Which creates this really fascinating divergence. The U.S. is saying, let the private sector, the Solanas, the Ripples, the stablecoins, build the rails. And Europe is saying, no, the central bank needs to own the rails.
It's a philosophical split. Europe wants a government-backed settlement layer. The U.S., with the Genius Act, is betting on the free market. But both are racing toward the same 2026 finish line, a fully tokenized economy.
It really feels like 2026 is the year where the rubber meets the road. We've spent years talking about potential and regulation, and now the laws are passed, the upgrades are live, and the institutions are actually buying.
That's the synthesis here. 2026 is a year of friction, but it's productive friction. You have institutions that are paralyzed by fear of space wars and trade wars.
And yet
they're pouring money into a crypto market that is rapidly legalizing.
it's almost ironic. The very volatility that institutions usually hate
Might be exactly what drives them to these new assets. I mean, think about it. If you're genuinely scared of the traditional geopolitical order breaking down,
trade routes blocked, sanctions flying.
a decentralized digital financial layer starts to look less like a casino and a lot more like a bunker.
Especially when the U.S. government has stamped it with the Genius Act and said, this is legal.
Exactly. The legal victories, like the Ripple case, remove the regulatory risk. Now, the asset just has to stand on its own merit.
Which brings us right back to that Bitcoin price.
Yeah.
$86,600. The break-even point.
It's a precarious spot. But here's a final provocative thought for you.
Let's hear it.
If the break-even price for the institutional class is $86,000, and despite the outflows, wirehouses are still onboarding clients and buying, have we reached the point where the so-called risky asset is viewed as safer than the geopolitical instability of traditional markets?
That is a wild thought. That Bitcoin might be the safe play in a world of Arctic conflict.
It's a possibility we have to consider in 2026. The very definition of safe is changing.
Well, there you have it. We're going to be watching the Clarity Act in the U.S. Senate, which is still pending, and that Project Pontus launch in Europe as the next big signals.
Those are the ones to watch.
Thanks for diving in with us. We'll catch you on the next one. Stay curious.